Hi everyone, so today's investor question is a follow-up on our rationale video for Meta and PayPal. We've had some great questions that have come in and wanted to address those. Please keep those comments, questions, likes and subscribes coming in. It really does help our channel reach our intended audience. So thanks for that. If you haven't watched our first video on FB and PayPal, you might want to watch that first. Okay, so let's get into it. Some Q&A. Scott asks, with FB, they're arguably making a big pivot in long-term strategy with a push towards the metaverse. And with Mark Zuckerberg having 55% control, you live and die by his vision. Now post-earnings miss, his comment to staff, as it's been reported, is to focus on Reels to compete with TikTok, which is their most current threat. But how do you guys assess future opportunity for the business with such an unknown of what the metaverse will actually evolve into? Or is the network effect so strong in your opinion that it almost doesn't matter? This is a great question, or great questions. In Meta's case, the stock faced triple whammy. Not just high metaverse investments, upcoming losses. There's also the legit Twitter competition and Apple's ad tracking privacy changes. In the first case, the threat is real and concerning to some extent, as Reels is so far an inferior product to TikTok. But we would argue the market is surely large enough for multiple players, and nearly 3 billion network is nothing to bat an eye at. It seems Meta's family is more far-reaching and appealing to the general masses than, say, TikTok. Though we may eat our words on that comment someday, because granted, the Facebook app user base specifically shrunk for the first time. But what we're saying is it's hard not to be on Facebook. Not only is it the global directory, but there are many groups and invitations that happen through there. The users don't necessarily need to grow much in order for there to be a continued ad revenue growth through the platform. If you can reach the most people, that's precious advertising real estate where they can keep pushing up prices up little by little. Plus, any market share taking towards digital advertising. It's the market share taking within the digital space that's worrisome, as it appears advertising will be spread out much more, whereas from years ago. The thought was it was happening or is appearing to be a winner-take-most duopoly between Google and Facebook. Now, it's looking like Google and Facebook family will still be staples, but there will be more market share taking amongst other competitors like TikTok, Amazon Search, Twitter, Snap, etc. It's hard to know how it will all shake out, but it seems to us that nearly 3 billion users will continue to be monetized and grow. As for the Apple tracking ad privacy changes, it's worrisome that Snap's results weren't as affected, though they were previously. It's like Facebook lagged on this front. But even in this case, while those changes definitely affected ad relevancy and thus Facebook's ROI for advertisers, tell us, what form of advertising is superior? It's not radio, TV, and newspapers. So it seems clear the digital space will continue to take share, but we do think the privacy changes has made it more difficult, and thus we think dollars are likely to spread out more. But again, there's surely still enough room for many winners, and we like the idea of owning the largest network in the company that is likely not overvalued for behavioral reasons, meaning Facebook is definitely no longer a get-rich-quick stock. And so if history is a guide, there's a good probability it's undervalued and likely to produce decent returns from here, in our opinion. Remember, this is not to be considered a recommendation to buy or sell the stock. As for the $10 billion of cash flow that was funneled into metaverse investments last year, and the $13 billion that will be as we look forward, while it's disappointing, and we're not personally convinced those metaverse investments are going to pay off, it all comes down to how much cash they generate after they spend money on this expensive option. We say expensive, consider they paid $1 billion for Instagram and $2 billion for Oculus. And if the option works out, it's just sugar on top. So without the metaverse, it appears they'd be making $50 billion and growing each year. And we could easily see the company trading at 20 times that, or $1 trillion valuation, or easily more, frankly. If you ascribe a zero valuation to that optionality and assume these metaverse investments would continue for infinity, yielding no benefit, then just chop 20 to 25% off that. And that puts you at about a $750 to $800 billion valuation. And it's trading just over $600 billion. Keep in mind, there's no way they're going to continually bleed this much for infinity. Because if it doesn't work, we believe the bleeding would eventually come to an end. Though I suppose it could be true that 20 to 25% of their cash flow gets wasted towards something else forever. But it seems to us that the market has overdone it, which it usually does, by ascribing the current short-term waste to over the entire life of the company. So when we look at the valuation, it seems extremely reasonable, and we believe that potential challenges have been far more than factored in to the stock price. The market is over-discounting the known cash flow even after you subtract out the Meta waste. Thus, Meta investments are a free option in our opinion, and is some of the cash flow. Frankly, the last time the stock took a hit, that seemed more reasonable to us, and we felt that drop already appropriately factored things in. This recent hit seems like the market has discounted it a second time for the same reason. So when owning Meta, you still own the dominance of a cash-flowing 3 billion user network inside the advertising industry, which itself should maintain its share of growing GDP over time. Looks like a decent bet to us. But the key is we don't want to oversize it with client portfolios either, as there's no question there's some uncertainty here and a wider set of outcomes. For now, it'll likely just be a dark cloud hanging over the stock, but that makes it all the more attractive because you just never know when those clouds will lift. As always, consult your financial advisor for what's right with regards to your own personal situation. Okay, our next set of questions are regarding PayPal. I'm a novice, but it seems to me that PayPal was trading up in 2020 and 2021 with high growth stocks and also had a correlation to Bitcoin, not to mention other ARK stocks. Do you think they were unfairly lumped in with that group, and how do you assess the risk or opportunity of blockchain for PayPal as well as on MasterCard and Visa? Next question. With PayPal now back to 2019 levels, you'd think perhaps any excess speculation has been taken out of the shares and perhaps they are back to a reasonable level. Is this business now more attractive at these levels to where you'd increase investment weighting? Or have the current risks now been repriced and appropriately so into the shares? Okay, so there's a lot to unravel there. Great questions again. As for PayPal, we see what you mean about it being lumped in with Bitcoin and ARK stocks. And that's because it was viewed as the disruptor. But we don't think blockchain is a major threat. We're much more concerned about the plethora of competing fintech companies out there. We think right now the major concerns over the stock are the end of tailwinds from the pandemic, the end of the eBay relationship, and ultimately that's led to a slowdown in the number of new active accounts. The market didn't like hearing that customer acquisition is proving to be more costly with low ROI on incentive programs that only led to churn. And when a high multiple stock has growth expectations that fade, the bottom drops out. Admittedly, we bought way too early, or really we bought way too late and should have bought even later, as in now. But you can never know for sure that a huge buying opportunity like this would be coming along. And so our valuation concern and uncertainty over disruption caused us to keep the position size very small. Would we increase our weighting now? Potentially, now that the valuation is much more compelling, but not by much, as disruption risks still linger. But anyway, the news was legitimately disappointing with far less growth than anticipated. However, it still grew double digits, and all the long-term positives outlined earlier in this video still apply. We wrote additional thoughts on PayPal on our advisor website, and you can click on that link down in the comments section below. To elaborate on why we currently dismiss blockchain, the main question to ask is, will blockchain offer a solution that is better than PayPal, which ultimately mainly runs over the MasterCard and Visa platforms? What's made those credit card networks so valuable? It's a convenient, safe, effective, and rewarding solution to consumers, and any competing threat would need to possess all of the following attributes. 1. Broad acceptance among the banks, consumers, and merchants, creating a massive network effect. For us, it seems to be happening as digital currencies are becoming much more commonplace. Even Intuit has just partnered with Coinbase to allow tax refunds in digital currencies, but it still has a long ways to go still. 2. Ease of use. This is happening, but not true yet. Compared to whipping out your tap credit card or Apple Pay at point of sale systems, or compared to logging into the PayPal online. Number 3, speed of transaction processing as well as capacity and scalability. This is definitely not the case here at all. Although improvements are slowly being made with stable coins, but it's still very slow. Remember, blockchain technology can only handle about 5 to 8 transactions per second due to electrical power required, compared to thousands of transactions per second for MasterCard and Visa. This seems to be a huge hindrance though it's also somewhat a benefit in the sense that you can move millions of dollars in minutes across the globe over a weekend compared to wiring money between international banks, which would take days. Number 4, security and reliability of payments. Blockchain is superior, though this is one of the major allures of PayPal at the moment, as opposed to giving your card data to a random online vendor. Number 5, cost of use. We think blockchain could be superior as it's decentralized and doesn't require a middleman, but the power consumption required is also enormous. It's been noted that Bitcoin's blockchain commands half the energy consumption of the country of Ireland. Again, this is evolving as they try and move from proof of work to proof of stake methods. Number 6, stable. We think of digital currencies more akin to digital gold investment, and so I think the fluctuating nature of the currency will always pose a problem. We suppose you could say the US dollar is always fluctuating relative to other global currencies, but a fluctuating digital currency value is more in your face. And the risk of it going up and down on a daily basis, we think will prevent it from taking major share as where you store your transactional cash. We could be wrong as it becomes an alternative to buy your Tesla or hamburger at McDonald's, but it seems to us it's more useful to move a large block of money across the globe in a matter of minutes. But then we think users would want to convert it to local currency unless it is intended to remain as a speculative commodity or currency allocation. Number 7, card data. Perhaps it's possible, but at the moment, there are no tools that we're aware of to categorize, say, your Bitcoin purchases like you can credit card purchases. Number 8, governance. With no leadership or governance system, which is part of the allure, right? Could it also be a hindrance as there's no clear structure for decision making? This is a big hurdle for mass institutional investing. Number 9, governments. There's the incentive to control and make them illegal if it causes citizens to evade taxes and participate in nefarious activities. 10, rewards. We're not aware of Bitcoin or any blockchain-based currency offering 2% back or anything like that, which we get from MasterCard and Visa. And we're not sure how that could be developed because that percentage comes from a middleman giving up some of their profitability. Number 11, speed of adoption. If somehow blockchain were to overcome all these points and become a viable alternative for current payment networks, we just think this is going to take a lot of time before it's completely widespread. Lastly, PayPal, MasterCard, and Visa see the threat and are all becoming involved and could potentially pivot if the threat becomes a reality and possibly figure out a way to continue to monetize their existing network effects. Hopefully this has been helpful. Thanks for the great questions today. Check out our other videos and we'll see you next time. Thanks for watching. All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.